Hello there. Welcome to Commodities. Let's check out the energy market first off, because we do have what looks like a gathering storm in terms of global crude supplies. Oil is down today, but that's after a sharp run up this week. And amazingly, WTI oil from a low base is up something like 30% so far this year. There is a look at oil. Look at the spike we've seen over the past few sessions. This Israeli-U.S. assault on Iran has essentially shut down exports through the vital Strait of Hormuz, and Tehran then has been attacking ships in that waterway and also energy facilities around the Gulf. Supertankers are avoiding the strait. Apparently, a massive queue of ships now stretches to the south of India and beyond. Asian energy buyers are spooked because they get a vast amount of their energy from the Gulf, and so the ships, of course, there's going to be competition now for cargoes. Aluminum is up, hitting a multi-year high. Bahrain is a huge exporter, and it has halted deliveries because it can't get it out. And Qatar, it has billed itself for years as the world's most reliable LNG supplier. Well, that's been shaken after it had to shut down a huge facility after a drone attack. So ships lined up, and globally, the whole energy system is adjusting. We're seeing price increases for gasoline. Right now, the latest price I saw in Toronto was north of $1.40, $1.44 a litre. U.S. President Donald Trump says the Americans will provide insurance guarantees and naval escorts to get ships through the Strait of Hormuz. But the energy industry saying that's going to take time to organize. And Marsh, the giant insurance broker, saying it's not going to be a simple thing. Bob McNally of Rapidan Energy quoted as saying the U.S. military will first want to suppress Iran's ability to mine and attack ships with anti-ship cruise missiles. There is a look at TSX energy stocks trading near a record high. We're going to have lots more on this massive disruption to the energy market later in the show. And let's check out what the metals are trading. Interestingly, gold is down this week. It is higher today, but it hasn't seen the rally you might expect as people seek out a safe haven. Over at Bloomberg, Skylar Montgomery Koning writing that already gold's had this huge run. It's become a crowded trade, and it's still a relatively small market, compared to the stock market. And so gold, this Bloomberg analyst arguing, has been trading in overbought extremes, and it's witnessed herding behavior. So gold's drop over the week alongside stocks yesterday doesn't fit that definition. And let's have a look at the agricultural commodities. So you can see crops are down. Apparently, this war has stalled fertilizer shipments out of the Persian Gulf region, of course, a huge source of nitrogen fertilizer. And that already has sent fertilizer prices up, and that is likely to harm the market for crops. But you can see right now, food prices under pressure. And so fertilizer prices are up. Now, maybe this is a manipulated leak, but Bloomberg says the U.S. administration is investigating whether any big producers of commercial fertilizers have been colluding to raise prices. And there's a look at Nutrien. Nutrien, Mosaic, CF Industries, all said to be under scrutiny here. Some other commodity stories we are watching. Shares in SSR Mining surging today, up 14%. Precious metals producer is selling its 80% ownership stake in the copper mine in Turkey in a deal valued at $1.5 billion US. National Bank says this mine has been an overhang on SSR. Investors are happy with the deal. Shares in Capital Power, the electricity producer, down about 3%. The company reported profit in its latest quarter that missed expectations. However, revenue rose year over year. And the company says it's well equipped to meet rising demand. And shares in Next Gen Energy, the uranium developer, higher. The company did post a loss in its latest quarter, but it was smaller than analysts had been expecting. And the company is pushing ahead with plans to build a giant uranium mine in Saskatchewan. And of course, that could be the second one announced after Denison Mines just a few days ago said it's going ahead with its project. So oil prices dropped today after the U.S. indicated it is prepared to implement measures to stabilize shipments through the Strait of Hormuz, possibly by backstopping insurance for vessels or getting U.S. naval ships to escort tankers. We're joined now by Eric Lee, Global Energy Strategist at Citi. Eric, thanks very much. I was amazed today to see that WTI is up something like 30% this year now from a very low base.
Yes, I mean, part of that is that the backdrop to this market before this latest geopolitical uptick was that 2026 was expected to be a year of oversupply, right? So prices, this time last year were around $80 Brent. By the end of the year or early this year, they were in the 60s. So I think that's part of the backdrop for this. This of course, major uptick in geopolitical risk right now.
What is your take? I mean, people are talking about the Arab-Israeli war back in 1973 that saw oil prices soar, but of course the Arab countries implemented an oil embargo at that time. There's no talk of anything like that. But there are fears that this conflict could be drawn out and spread.
Yeah, absolutely. And there's a very difficult range of outcomes to contemplate. I mean, you refer to 1973. That was a cut of production of, I think, about 6% of world crude production at the time. I think somewhere around 3-4 million barrels a day in a 55 million barrel a day market. Here we are confronting multiple scenarios. The big one is what's happening now, and the question is how long it happens for, which is flows through the Strait of Hormuz go close to zero, and that's 20 million barrels a day of crude oil, mostly crude oil, a lot of petroleum products, and as you mentioned, well, other commodities, including LNG as well. And so if that's the biggest supply risk. If it moves back to something that's more internal Iran risk, where it's 2 to 3 million barrels a day of production and exports kind of is in risk for a long time, that's a different scenario and a lower but still elevated level. And of course, if we move back to deal making and flows can renormalize, we could be back at the low 60s. So there's a range of outcomes. And I think that's part of the trickiness of what's going on right now.
Isn't it interesting how, though, we've gone from, as you say, talk of a surplus and gloom hanging over the oil market in terms of higher prices to this huge turnaround?
Yes, and in some ways it's a continuation of the story from last year, right? Recall last June when we had the first, the last time U.S. and Israel bombed Iran's nuclear facilities. And at that point, oil also hit about $80 and then started coming off as there was this de-escalation. So certainly there's that question mark. On the other hand, you can compare to 2022 with Russia-Ukraine, where the fear of loss of 5 million barrels a day of crude or thereabouts led to oil prices moving to 130, 140 at times. So I think the backdrop of a better supplied market is helping to control some of those larger, higher scenarios. But again, the Strait of Hormuz with 20 million barrels a day of flow and only limited bypass pipeline capacity, mainly through Saudi Arabia, is just something that can overwhelm even that sort of bearish backdrop.
And Qatar has billed itself for a long time as a reliable LNG producer. And we just saw North American natural gas not reacting because, of course, we're self-sufficient really in this part of the world in natural gas, more than self-sufficient. But Qatar, that's a blow to them, isn't it? And a blow to Asian countries that depend on that LNG.
Absolutely. And to Europe, where, European natural gas prices contribute to the very high energy prices that contributed to a chunk of broad deindustrialization in many ways. And the fact that, global gas prices had eased off the past few years has been a relief to the European economies as well. And now we're back at TTF, global gas prices now spiked to 50, 55 euro per megawatt hour, back to 45 now. That's about $15 per MMBTU. So this has massive implications, and that's where again it comes back to this tension of the White House, the U.S. has, of course, various questions about what objectives are in Iran, but also is clearly very sensitive to high oil prices, high gasoline prices in the midterm election year. So there are a lot of reasons that we could, in a number of weeks, move back to de-escalation and deal making. But again, there are very, very many, which is our base case, but there are very many dangerous bull and extremely bull scenarios at the moment.
We've very few seconds left, and sorry about that, but we just showed a chart that indicates that an awful lot of Europe's LNG comes from America, although, of course, it gets pipeline supplies and it has other sources of gas.
Yes, I mean, I think the thing to say there is yes. But given that, if you take out Qatar, and that's, about a fifth of the global energy market, then Asia will need to also, compete for those same sources, and it will knock on Europe, even if Europe is not as big of a traditional buyer of Qatari LNG.
Eric, thank you very much indeed. Eric Lee, Global Energy Strategist at Citi. Okay, so we're going to be focusing on gold now. Why is it not working as a safe haven? We've seen I know prices are up, but it certainly hasn't surged. Despite its reputation as a safe haven asset, gold is actually down from Friday, despite the Middle East violence. Let's get more from Daniel Galley, Director of Commodities Strategy at TD Securities. Daniel, great to see you. Now, I know the US dollar has moved up, and that's always tough on gold, but it does seem surprising that gold's still stuck barely above 5,140 right now.
Yeah, absolutely. I'd say a lot of people are surprised about the market reaction in gold, but more broadly across assets as well. And I think one way that we explain that is that we have to account for the fact that quant funds in particular have become one of the dominant participants in commodities markets in particular, and very meaningful across different asset classes as well. And what we think happens in an event like this one, which is a stagflationary shock, that means a shock that is detrimental to growth and to the inflation outlook, but argues for higher inflation as well. The diversification benefits that are typically offered by asset classes starts to deteriorate. And simultaneously, because this is a war, the volatility outlook improves. And that's a recipe that results in a deleveraging for quant funds. This is mechanical in nature, mostly.
And so you said quant funds have become a bigger player in commodities.
Absolutely. I think that's been the case since the last bear market. Quant funds overwhelmingly explain the variation in money manager flows participating in commodities markets today.
Let's have a look at copper, because there's an interesting dynamic there, maybe a 1 year. The Middle East is a big source of sulfur, and that's an important mineral for producing copper. So this Strait of Hormuz blockage, or virtual blockage, it's just having spreading effects.
Yeah, absolutely. And you had a great guest earlier who was going through some of the dislocations that have occurred as a result of the blockages in the Strait of Hormuz. But the thing to remember here is that the Strait is really consequential for global supply chains. And so what we're starting to see, even just a few days into the war, is a ripple effect across the raw material space. We've seen nickel supply being disrupted. We think copper supply could also potentially be disrupted as a result of sulfur flows as well. So really, this is the mechanism that can start to be inflationary.
And now, what is your view on the U.S., the Fed? Like a surge in energy prices is inflationary. I know it's not quite that simple, but would that be enough to get the Fed to defer interest rate cuts?
Yeah, well, that's an interesting question, right? And goes back to the market reaction in gold. historically, the conventional thinking has been that a central bank will tend to look through a war impact. But the history has actually been far less conventional than that. And if you really look into it, you find that in every war in which a reserve currency nation has been involved, it's tended to be associated with a pivot from their central bank. And so there are these macro dynamics at play here. Rates markets have already priced out more than half of an interest rate cut before year end. And so there are these follow-through effects that have also hampered the gold outlook.
What about food? Because, of course, this could make food production harder if crucial nitrogen fertilizer shipments are disrupted.
That's true. And, again, going back to the Strait of Hormuz and how important it is, fertilizers, a large proportion of fertilizers have to pass through it. The same is true for LNG. The same is true for the Middle East's food security as well. Grains, seeds, soft commodities as well. The impact cannot be understated.
Daniel, thank you very much indeed. Really appreciate it.
Thank you, Andy. Always a pleasure.
Daniel Galley, Director of Commodity Strategy at TD Securities. Right. President Trump has said that Venezuela is a treasure chest when it comes to minerals, quite apart from oil. However, violent militias are standing between the U.S. and those deposits. We'll have more after this. We're having a bit of trouble right now getting to that story on the Venezuelan criminal gangs blocking access to crucial minerals in the south of the country. We'll hope to connect you with that shortly. Let's have a quick look, though, at the markets. We'll start off with the metals because gold, it is up today, but it's still struggling to post a gain since last Friday. Pretty incredible. Part of that is a stronger U.S. dollar. But as I mentioned earlier, Bloomberg's analysis indicates that it's become a crowded trade. A lot of the money has gone in seeking safe havens already, and it's not that big a market. So with so much money in there, in a tight market, which has pushed gold to record highs this year, it's subject to volatility. Let's have a quick look at gold, though, over the past 5 years at the PDAC mining show, where we had so much fun this week. People were just gobsmacked by the rise in gold. I mean, deals that were done a few years ago with gold under 3,000, even under 2,000. It now seems incredible how the environment has changed and the cash flow stemming to these companies, just incredible. We're not seeing much action in the gold stocks today. SSR Mining, as I mentioned earlier, jumping. Let's move on now to the energy companies. Maybe we could have a look at a one-year chart for Southbow, S-O-B-O. That's the pipeline company that was spun off by TC Energy a while ago, and investors buying into that stock. Of course, it tends to be a good old reliable dividend payer, and the dividend is north of 6% for Southbow. And we're looking for results from that company tomorrow after the market. And in fact, Bloomberg indicates that the stock has hit a 52-week high today. And I'm guessing that is a record high since the spin-off. Of course, it's not seen as a high growth vehicle, but with pipeline stocks, traditionally, you don't really care. Let's have another look at oil. Speaking of energy, let's have another look at oil, maybe year to date. Amazingly, Brent, the global oil contract, is up 34%. And look at that, oil itself up 30%. So if you were a savvy player at the end of last year and piled into oil, you're doing just fine. And let's have a look. And gold itself, even though it hasn't come through as a safe haven winner this week, it's still up about 19% this year and up almost 80% in the past 12 months. Aluminum, let's have another look. That commodity has rallied something like 9% this year in London. And Bahrain, a significant producer there, has been forced to cut deliveries Aluminum hitting the highest since 2022. There's a huge producer there called Alba, Aluminum Bahrain. Actually, it's Aluminium Bahrain, BSC, suspending deliveries due to the effective halt on shipments out of the Strait of Hormuz. Let's get to Venezuela. President Trump has talked about valuable mineral resources there. One of the problems, though, in the vast mining regions, there are armed groups. We're joined by Elizabeth Dickinson, Deputy Director for Latin America at the International Crisis Group. Thanks very much indeed for joining us.
Pleasure to be here. Thanks for talking about this important subject.
It sounds a tricky one, doesn't it? How is President Trump and how are U.S. mineral companies going to be able to get those armed groups out of the way? I mean, President Trump presumably is in no great rush to push ground troops in there.
Well, as you mentioned, Venezuela is home to a rich supply of critical minerals, including what are known as rare earth minerals, fundamental, of course, for technology applications, the defense industry, and the United States has repeatedly expressed interest in exploiting that mineral wealth. The problem is that those mining areas, most of them are in remote zones close to the Amazon jungle, for example, are largely run with a presence of, or in the management directly, of armed and criminal groups, including groups from Colombia that have crossed the border and have exploited the mining industry to finance themselves. We're talking about gold, but also, of course, coltan and other rare earth minerals. These armed and criminal groups essentially work in collaboration or in coexistence with the Venezuelan security forces, who in turn receive a cut of the price for these minerals that are being sold.
The criminal groups, apparently they're digging, there's a national park in Venezuela, and satellite images show deep gashes in the earth, according to the Wall Street Journal. So they're pretty destructive, and there's child labor is common, as with other illegal mining operations around the world.
Well, precisely because these mines are in such remote areas and because their control is taking place under the purview of armed and criminal groups, respect for even the basic conditions of, mining practices are not respected. So we're talking about mercury poisoning, for example, trying to extract gold. As you mentioned, forced labor is very common. These are areas where indigenous communities are their primary inhabitants. And we have seen that members of those communities are essentially forced to work in the mines, often without pay and in conditions where they're exposed, for example, to infectious diseases. Malaria has proliferated significantly in mining areas in Colombia, in Venezuela in recent years for the same reason.
Elizabeth, we'll have to leave it there. Sorry, it's such a short time. Thank you very much. Elizabeth Dickinson of the International Crisis Group. We're out of time on commodities. Thanks for watching.